Next week may as well be the start of the so-called earnings recession. Many market participants are keeping an eye on next week's tech earnings. Take a listen.
But it comes also as this sector looks, I don't know, I'm not going to say wobbly, but yesterday was kind of ugly. Are we primed for a pullback, or is this just a momentary blip?
Well, let's look at the numbers, Scott. If you look at the global technology index, that's up roughly 40% year to date. Semiconductors are up 45%. Software is up 40%. So yeah, it wouldn't surprise me at all if we saw a bull market consolidation over the next 3 to 6 months or so. When we look out 18 months, which we're always trying to optimize for in our strategy, we still like the space. We still see fundamentals inflecting positively. We still have relatively reasonable valuations.
It seems that Netflix and Tesla earnings may have injected some anxiety into the markets. The already revised lower earnings expectations may not have been low enough.
This terminology already priced for perfection. What some suggest that Netflix and Tesla were, and that's the reason why even it's not like their earnings were horrible or anything like that, but the stock suffered somewhat significantly, at least for a day or so. Who in your ownership group do you think is now most priced for perfection that you would worry could have a pullback?
Well, again, like I said, a lot of different stocks may pull back in the relatively short term, but we still feel good on the medium to the long term. Netflix and Tesla are great examples, right? So Netflix actually had very positive fundamentals in the report. I think the trend on password crackdowns is going quite well, and I think that the advertising tier is starting to see some positive inflecting data points. Now, the question is, are we going to get more ads in the next quarter than we did this quarter? Who knows? That remains to be seen. On Tesla, on the other hand, you actually saw some really positives in that fundamental report as well. Cost per unit is going down very nicely, and of course, if we get a full self-driving OEM adoption, that would be very positive for the stock. So that's why we saw those two stocks pull back a little bit.
I'm thinking of a couple of others I'm looking at in terms of what I have as your top holdings, and maybe not full-fledged warnings, so to speak, on where we are, but ringing the bell at least to say, hey, you got to pay attention here. Warnings this week from Taiwan Semi, right? You got that. SAP, when what they did yesterday in terms of their earnings and their guide dragged down the cloud software space. You have ServiceNow as well. So how are you thinking about those if we get away from the mega caps for a moment?
Yeah, I think TSMC is a perfect example, Scott, about how this AI battle is going to play out, right? So let's look at TSMC's numbers. TSMC guided that their revenue would be down 10% year over year. That's okay. But if we look at AI itself, the AI business, which is roughly 6% of their revenue, is growing at a 50% CAGR over the next 5 years. It's not often that you see that fast of a CAGR. And when you have that small percentage of your business growing that quick, it doesn't take that long to see those fundamentals really play out in the long run. If we look at TSMC is only trading at 15 times fiscal 2 earnings, and fundamentals should probably bottom here in Q3. And then from there, we're going to see
Next week may as well be the start of the so-called earnings recession. I would love to hear your thoughts in the comments below.